Hi guys, I hope you all are doing well. Welcome to this financial management revision marathon session. This is Luqman Rafiq here. It's really good to see you people joining in this session in a very big number. Hopefully, inshallah, we will have a very amazing and a very productive session. Let me just guide you that my agenda for session of today is that I want to go about discussing the section C of the examination, and I want to do multiple practice questions pertaining to section C of the examination. That's what I would actually try to do. That would include the working capital, that would include the sources of finance, the cost of capital, the investment appraisal. So multiple topics. That's what we are actually going to cover up. In the meantime, I've got Enzuza here. Enzuza, a big shout out to you. It's really good to see that you have been submitting assignments very frequently, and obviously you've been getting feedback. So I think you people have submitted a lot of assignment, and it has been really good to see the way that you people have been participating. So thank you very much for your contributions towards this, because it's really pleasing to see that you people are actually participating and actually being there for the respect to submission of the assignments. Now, so what I will be doing is I would be going about discussing the CB pass examination of the ACCA. So I would just open up the CB practice platform of the ACCA. This is the ACCA CB practice platform. So I've opened it up, and what I'll just do is that I will open up the ACCA financial management pass examination questions. So there are these latest pass examination questions that are available. What do we have? Yes, we have got these questions from um, December 22, June 23. So what I'll just do is that I'll just open up the June 23 and the December 2023. That's what I'm just going to open up so that we could have a discussion. So basically, financial management is what I'm actually going to start off with. And the two papers that I'm going to be discussing about is the December 2023 and the June 2023. That's what I'm actually going to be talking about, because they are some of the recent examinations that have happened with respect to this paper. So obviously my focus is the section B. My focus is the section B. I would be focusing mainly on section B of the examination. Okay. So there is this first question, which is about the Pulobro company that produces household products and so on, so on. So there's a lot of details available. But what is information here relevant for me over here is that it is saying that discuss the difference between the risk and the uncertainty. What is he suggesting? The difference between the risk and the uncertainty. In the context of investment decision. It's a 3-mark requirement, and you have to talk about the differences between the risk and uncertainty in the context of investment appraisal. In the context of investment appraisal. In the context of investment decisions. Now let's talk and let's have a discussion about it. So basically, what exactly do you mean by the risk and the uncertainty? In the investment decisions, the risk and uncertainty are defined as under. Risk is a situation where the risk is referred to as a situation where the probability could be assigned to the different outcomes. And when it comes to uncertainty, the uncertainty is basically probability cannot be assigned to the different outcomes, and instead the probability could not be assigned to the different outcomes, and instead uncertainty prevails. With respect to the decision making using the risk and uncertainty, the risk could define a situation where it could be said that there is a X% likelihood of something happening or something not happening. Whereas with respect to uncertainty, no estimations could be made. So the risk is when you can assign a probability. The uncertainty is that when the probability cannot be assigned. The uncertainty is when the probability cannot be assigned, that's when the uncertainty prevails. Now, what next is there? The next situation is, it says calculate the nominal. Nominal is inflation adjusted. When we talk about the nominal, nominal is inflation adjusted net present value of the investment project and comment on its financial acceptability. Number two, calculate the, okay, sure, I'll just go back for a minute. Here you go. Now it says calculate the nominal present value of the investment project and comment on its financial acceptability. Calculate the sensitivity of the project net present value to change in the level of contribution per unit. Calculate the sensitivity to a change in the discount rate. So that's what we have to do. Now what I'll just do is that I'll just drag it out and I'll allow you to actually have a look at the whole of it. Can you just go through it, please? Okay, let's just start. So it says Poloro company produces household electrical goods for its home country market and market in neighboring countries. Poloro is planning to make major investment in new production facilities to produce an upgraded model of its cooker. Poloro's finance director assigned probabilities to a number of possible sales volume of this new model. Based on the previous experience of launching upgrades, he has calculated annual expected sales for 4-year time period. That means it's gonna be a 4-year time period for the sales. How much is it gonna be? It is gonna be 4-year time period for the sales, over which the investment will be assessed. However, after a number of years of a strong economic growth, the company's home country and its neighbors appear to enter a period of recession, meaning that consumers may be willing to spend less money. Initial investment will be $39 million. Finance director assumed there will be zero realizable value at the end of 4 years and the working capital can be ignored. So this is important. Working capital is to be ignored and there's going to be zero realizable value at the end of 4 years. The expected volumes of sales are as follows: year 1, 2, 3, 4. Expected contribution from the upgraded cooker throughout the 4 years is $200 per cooker. This will not be affected by the rate of inflation. Incremental fixed costs are expected to be 2.5 million in year 1. They will increase by the rate of inflation in each of the year 2, 3, 4. The company pays corporation tax of 25% per year, 1 year in arrears. No tax allowable depreciation is available on the investment expenditure. No tax allowable depreciation is available on the investment expenditure. The company currently uses 11% as the after-tax discount rate to appraise the investments like this. One of the other director has commented that he thinks the level of contribution that the finance director assumed is too high. He also wondered that with the economic uncertainty, the cost of capital should be higher. The finance director has said that he will prepare sensitivity calculations showing in relative terms the level of change in contribution and discount rate that would produce a nil present value. Another director has stated that she has heard that probability analysis can be helpful in decision making and wonders if the same as the sensitivity is going to prepare the same so and so so and so. Now let's just move a bit forward. So if we talk about the nominal present value of this, just try to understand. Time period 0, 1, 2, 3, 4. Contribution is 200, 200, 200, 200. Number of units are gonna be 60,000, 150,000, 140,000, 80,000. Total contribution is gonna be this is what the total contribution is gonna be. This is what the total contribution is gonna be. Now, what happens is that the fixed cost need to be deducted from here. So when you will have a fixed cost that needs to be deducted from here, it is actually gonna be minus equals to minus 2.5 into 10 raised to power 6 just to convert this into million. And this is gonna be into 1.06. So basically what happens is that the profit is gonna be this plus this. The profit is gonna be this plus this. And then is there the investment? Yes. $39 million is the investment. So hence the total cash flows net present value NPV function is equivalent to NPV bracket open, comma. Okay, I think I've made an error. The company pays tax 25% were in arrears. So I made an error. Taxation at 25%. Profit after tax is gonna be 11%. So you have got the NPV function as this, comma, 11% plus this. Okay. If just in case in the examination you get a stuck, so all that you have to do is that you have to just go through this average, this formula, and then you have to just go through the calculation. So I've made an error. The NPV is rate, then the values. So this is the NPV function is going to be 18.84 million is what it is going to be. Yes, knowledge, that's how we do it. Yes, yes. Um, So the inflation would then be applied on the year one. Okay, let's move a bit forward and let's talk further. Now the question says that calculate the sensitivity of the project's NPV to a change in the level of contribution per unit. Now basically number two, sensitivity is calculated like this. NPV divided by present value of the cash flow. So basically present value of the contribution is as under. So what have I done? I've actually have got the contributions for each year. I've calculated the present value of those contributions. Now when I've got the present value of those contributions, so I would actually say that sensitivity is gonna be like this. Is gonna be like this. This divided by this. So 28.54%. How much is it? 28.54%. Okay, see, if you are being asked for the selling price, then what you would do is that you would actually be using the total sales. If you are being used, if you are being asked for the contribution, you would do the same thing. So basically what happens is that some way or the other, this is what it is going to be. The contribution per unit is if it is 28.54% change, because you see, when we talk about sensitivity knowledge, we always assume there is only one variable that's changing. The rest of the variables are staying the constant. So we need to just change one variable. That how much percentage change in one variable would actually make it a 0 NPV. If you want, just for the sake of your understanding, see the answer was how much? 28.54. So if I could say 200 multiplied by 1 minus 28.54, 142.92377. If I apply this like this, 142.9377, let's say. So see, NPV was almost zero the NPV. If I change this contribution per unit, NPV is almost turning out to be zero. Now, there's obviously a rounding off issue. That's why things are like this. But if your contribution per unit becomes 142.939237, automatically the NPV would become zero. The NPV would become zero. Now it says calculate the project's sensitivity. Now, number 3 is that sensitivity to the discount rate change would mean that IRR is to be calculated. Sensitivity to the discount rate change would mean that IRR is to be calculated. Now, here, what is it? Again, I'll go to the formula sheet. IRR values and then guess. So IRR is gonna be, see here, cash flows. 0, 1, 2, 3, 4, 5. So year 4, year 5, I think we made some issue. Okay, things have changed a bit. Okay, so the problem here is that because of this another discount rate being negative, the NPV is an issue over here. So anyways, I would use the discount rate as 10% one, and then present value, and then another discount rate, let's say 15%, and then let's say present value. Yeah, but ideally you should remove the workings, because ultimately just to avoid the confusion for the examiner. Just to avoid the confusion, you should remove it. So IRR is basically 14.31%. Now see, so what actually happens is that the existing discount rate is 11%. The difference between the discount rate and the IRR is this much, and the difference in percentage terms is actually going to be this divided by this. So it is actually going to be 30%. So that means, just in case if there is a 30.08% increase, 30.08% is the sensitivity of the discount rate to discount rate, is the sensitivity of the discount rate. What is it? It is actually going to be considered as sensitivity to the discount rate. Is considered to be the sensitivity to the discount rate. Yeah, is that okay? Now let's move a bit forward. So it says compare and contrast sensitivity analysis and the probability analysis are the methods of assisting investment decision when there is more than one possible outcomes. Now, can you just think of few pointers for this? Can you think of few pointers for this? Okay, so see what happens is that when what we could do is that we could say, you could even answer it like this. You could just create a table from here, and you could just put in the table and you could say that what is going to be there, sensitivity analysis, and here you could have the probability analysis. So you could actually list down the pointers this way also. So single variable considered, multiple variable considered, have limitations with respect to considering, have limitations if we evaluate using the real life scenarios, can consider multiple outcomes, which is close to how the reality is. It can only identify the most sensitive variable and does not comment on whether the project is to be undertaken or not. It helps in ascertaining the most likely outcome of the project and how it will lead to achievement of the creation of the wealth. So that is what the major difference is between the sensitivity analysis and the probability analysis, right? So sensitivity analysis and the probability analysis, that's where the difference is. Okay, that's okay, not an issue. Okay, let's move a bit forward and let's take things further. So there is this question which says using after tax. Now this is a question on the back. It says using market values, calculate the after tax weighted average cost of capital of Marble company. So that's what you have to do. You have to calculate the after tax weighted average cost of capital of Marble company, right? Now, can you just go through it and can you just try to calculate the after tax WACC of the Marble company? Can you just go through this scenario, please? And can you try to calculate? I'm giving you 5 minutes. So Marble company wishes to calculate its current weighted average cost of capital as part of a review of the company's performance in delivering the shareholders value. Dividends per share paid to ordinary shareholders in the recent years are as follows. So the dividends for 2007, 6, 5, and 4 are given. And then what actually happens is that it says this is the dividend for X8 is 0.84 per share is due to be paid shortly. Marvel has an issue 226 million ordinary shares with a nominal value of this and a current cum dividend share price of this. They also have an issue 20 million preference shares, so and so, so and so. Now see, if you have to calculate the weighted average cost of capital. So for the weighted average cost of capital, you need to actually do these things. You need to prepare a table source, which is the value in terms of dollars, the cost in terms of percentage, the cost in terms of dollars. So what actually happens is that we have got the equity, we have got the preference shares, we have got the convertible loan notes. So these are a few things that are there. which is value, cost, dollars, etc., etc., etc. Now, what else is there? The next situation is, so let's just try to do one by one for each one of them. Now, if I talk about the equity, the market values of the equity are going to be what? The market values of equity are going to be what? The X dividend price is, the X dividend price is 11.93 minus the dividend which is proposed is 0.84. So 11.09, that is the X dividend value. What is the X dividend price? 11.09. That's the X dividend price, that's the market value, right? Number of shares are gonna be what? Number of shares are gonna be 226 million. So the value of equity is going to be this multiplied by this. So 2506.34 million is the value of the equity. 2506.34 is the value of the equity. Now, if I talk about the cost of equity, so I need to actually use the dividend valuation model. Now, for the dividend valuation model, the first thing that I need is the growth rate. How would I know the growth rate? The growth rate is actually going to be your current dividend is 0.84 divided by 0.69, and this is basically power 1 upon like this is the growth has been like what? 1 year, 2 year, 3 year, and the 4th year. So power 1 upon 4. This is whole. And like what you need to do is that you need to say, sorry, I just actually, it's no, it is actually going to be 0.84 divided by 0.69 power 1 upon 4. Then this is minus 1. So hence the dividend growth rate is going to be what? 5.04%. Dividend growth rate is going to be 5.04%. So I repeat, the dividend growth rate is going to be 5.04%. Okay. Now when we talk about the cost of equity, so for the cost of equity calculation, you know this thing that you actually would be needing D naught, then D naught 1 plus G, then the P naught, and then G. So the G is needed. Okay. The D naught is 0.84. D naught 1 plus G is 0.84 multiply 1 plus so and so. The P naught is this 11.09. So hence resultingly, the KE is going to be what? The KE is going to be, the KE is going to be D naught 1 plus G divided by P naught plus G. So hence what actually happens is that this is 13.07%. What is it? This is 13.07%. I bet this is actually 13.07%. So 13.07%, and then what you could do is that you could just multiply it with the cost. You could just multiply it with the cost. That's what you're gonna get. Now, when we talk about the preference share, it says Marble also has an issue 20 million preference shares with a nominal value of $1 per share and a current ex-dividend price of 2.27. So if I talk about the preference shares, number of shares is 20 million. Number of shares is 20 million. Market value is 2.27. Dividend rate is 25% into 1. Okay. K preference share is basically calculated as dividend divided by market value. Dividend divided by market value. So the K preference share is going to be, this is the dividend divided by market value. So 11 point something is the K preference shares. Now what actually happens is that the preference shares market value is going to be 20 multiplied by 2.27. 45.4. The percentage of the cost is basically this. So hence, this is what it is going to be. Okay, Muzmura, that's okay. Now this is what it is going to be. Now what next is there? We've got the convertible bonds. Now, if I talk about the convertible bond, it says it is partly financed by 6.5% convertible loan notes with total nominal value of $94 million. Then what actually happens is that the interest on the loan notes has just been paid and the loan notes have an X interest market value of 107.11 per $100 nominal value loan note. Market value is 107.11. Nominal value is 94 million. So total market value is gonna be this divided by 100 multiplied by this. So hence the total market value is gonna be like this. Now, at the end of 5 years, the loan notes will either be redeemed at full value or converted into 8 ordinary shares. Future share price growth is expected to be so and so, so and so. The loan notes are secured on the current loan notes. Now, for the redemption / conversion, Uh, for the redemption slash conversion, the redemption is gonna yield you 100. The conversion is gonna yield you how much? It is like each bond is convertible into 8 ordinary shares. Each share right now is worth 11.09 multiplied by 1.06 power. After how many years it is actually redeemable? It is redeemable after 5 years. So power 5. So 118.724. So obviously conversion will be chosen. Conversion will be chosen. Now for IRR, which is actually going to be the cost of the bond, what is actually going to happen is that year cash flows, right? So you have actually got 0, 1, 2, 3, 4, and 5. So what actually happens is that at time period 0, you would actually show the market value of this bond as a redemption. And for each of the year, it is like 6.5%, 6.5% multiply by 100 multiply by 1 minus 0.26. This is what it is. The after tax interest is going to be. So you have it for all the 5 years. And in the 5th year, this is what it is going to be plus the redemption value. So in the 5th year, it is what it is going to be. Now, the cost using IRR function, the cost using IRR function is going to be like this. The cost using the IRR function is going to be like this, 6.4%. So what are you going to do? You're going to put this to be 6.4%. 6.4%. Hence, resultingly, what happens is this is what it is going to be. And now what do we have? We have this. We have this. So basically, the WACC is gonna be this divided by this. This is what you will actually get the market value weighted average cost of capital. This is what you will get as the market value weighted average cost of capital. Is this okay? Is it making sense? Okay, conversion and the redemption part, I'll just tell you. See, each bond is convertible into 8 shares. And right now the market value was something like 11.07 or something like that. And the share price is expected to grow by 6% for a period of 5 years. Right? So this is what it is going to be. Okay, so we have the weighted average cost of capital. If there is any question that any one of you has, do let me know. I'll be happy to answer. If there's any question that any one of you has, do let me know. I'll be happy to answer. Okay, I'll just highlight on the redemption calculation part. Okay, here you go. You can just check it out. Okay, the 8 is basically, it told us that it is actually convertible into 8 shares. Let me just show you. Let me just show you. Just a second. At times, you know what? It actually gets stuck badly. Mhm. Will be redeemed at value or converted into 8 ordinary shares. Can you see this 8 ordinary shares here? Yeah, do you get it now? Okay, lovely. Now, shall I move forward now to the next question, next part? Okay, now what we have is we have the next part, discuss the relative merits of capital asset pricing model and the dividend growth model in calculating the cost of equity. Now, for some of the questions, I would strongly recommend you people to look at the examiner's answer because this is purely theoretical thing. And what you could do is that you could prepare a table like this and just put in the answer. That is what you could actually do with respect to it. So you don't have to actually go here and there. You could just look at the examiner's answer from the past and we could just work along that, right? Okay. So we take a short break and then we'll come back again and we'll continue further. Okay, so let's resume now. And what we are going to do now is that we are now going to move on to the next examination. Basically, we did talk about this December 2023. Now I'm actually going to move on to June 2023 and I'll take up the things for the June 2023 examinations now. So we have the June 2023 examination. And in this June 2023 examination, what we have is we have this, we have these questions which are about the rights issue and etc, etc, etc. So let's just start discussing about it. Now, first question is calculate the theoretical ex-right share price, calculate current earnings per share before investment in the project, calculate revised earning per share and the share price, calculate current gearing and revised gearing, discuss the views of directors and both the small and the large shareholders in relation to the new project and its financing. Now, can you just go through it? Can you just try to do some calculations? I'm giving you 5 minutes. Can you just take a screenshot of this? Yeah, can you take a screenshot of this? Can you take a screenshot of this? Now, if you've taken a screenshot of this, can you just take a screenshot of this also? Yeah. Now, so what you need to do is that you need to actually try and calculate the theoretical ex-right price. Then you need to actually calculate the current earnings per share before investment, so on and so forth. Can you just give it a try, please? Okay, let's just start. Now, when we see this, so what actually happens is that let's try to see this. It says that Grafham Company's directors are planning to invest in a new project, which requires $18.9 million of the new finance to be raised. So what do you need? $18.9 million of the new finance. Grafham Company's directors have used a mix of debt and equity finance. They've used a mix of debt and equity finance to finance recent investments, but have become concerned about the level of Grafham Company's gearing compared with the industry average. Therefore, they have decided not to use debt finance to fund the new project. So they are actually not going to be using the debt finance. The finance director has proposed a 2 for 5 right issue to existing shareholders at a 25% discount to the current market price of 8.4. So existing market price is 8.4 and they want to issue it at a 25% discount. The nominal value of the ordinary share is $2 per share. So that's nominal value. Our Grafham's chairman has received objections from some small shareholders owning less than 5% of the issued share capital each on the grounds that they do not have sufficient cash available to pay for the new shares. Grafham's large shareholders owning more than 10% will be happy to subscribe for the right issue. However, they want the new project to earn at least the same operating profit margin in percentage terms as the current business does. Operating profit is measured as this. So operating profit margin is measured as profit before interest and tax divided by revenue multiplied by 100. Financial statement information prior to raising new finance is this. Corporation tax is payable at the rate of 16% per year. The nominal value of Grafham Company's loan notes is $100 per loan note. And the market value is this. Grafham's price earning ratio can be assumed to be unchanged by undertaking the project. Current industry gearing ratio is 25%. New project is expected to earn $20 million revenue each year and have an operating profit margin of 18%. If the project is successful, there are expected to be opportunities to invest in further projects offering higher operating profit margins. Now let's try to see this. Let's try to understand how things are gonna be. Theoretical X right price, existing shares, right shares. So how many existing shares are there The existing shares are 5. 5 at what price? 8.40. Then you would be issuing 2 at a price of 25% discount. This is what it gives, 54.6. What is it? 54.6. Now for the 54.6, what is actually going to happen? Try to see this. Now, this is the number of shares. 5 plus 2 is 7. So theoretical extract price is going to be this divided by this 7.8. So theoretical extract price is going to be 7.8. Theoretical extract price is going to be 7.8. Right? So the theoretical extract price is 7.8. It says calculate the current earnings per share before the investment project. Current EPS. EPS is profit before interest and tax divided by number of shares. So the PBIT, number of shares, $9.5 million. The EPS is gonna be right. Now, what's the third one? The revised EPS and the share price after investment in the project. Existing PE ratio, share price, EPS. So your share price was 8.4, EPS was 0.63, PE ratio is 13.26. 13.26 is the PE ratio. Existing PE ratio is 13.26. Now, what actually happens is that the revised profit is going to be how? The existing PBIT Okay, just wait a bit. I think I've made one error. I used the PBIT, which is wrong. It should have been the PAT. I made a bit of an error. Sorry about it. So EPS is PAT divided by number of shares. You are not being given the PBIT, you're being given the, so PBIT is given here. Now, what we need to do is that we need to say how much interest is there. So your interest is gonna be 25,000 into 8%. So profit before tax is gonna be this plus this. The tax at the rate of 16%. The PAT is going to be this plus this 6,300. So if you want to calculate the EPS is gonna be this divided by this. Okay, so you have an EPS of 0.42. The P ratio is 20 times. P ratio is 20 times. Okay, so now for the revised profit, you need to have the existing PBIT. I could say existing PBIT, yes, here. Now what we have is the new project and have an operating profit margin. New projects margin is gonna be 20,000 multiplied by 18%. Revised PBIT is gonna be this plus this. The interest is gonna be the same, I think, because there is no new loan that we are taking. So you have got the PBT. The tax at the rate of tax at the rate of 16%. Then this is the profit after tax. So this is actually going to be this plus this 9324. This is the profit after tax for the revised. Now, the number of shares, existing number of shares is 15,000. Okay. There is additional issue that we have. I think the par nominal value was $2, right? So we need to change this a bit because it is 15,000 divided by 2, 7,500. So existing number of shares is 7,500. What we need to do is that we need to add the right shares, which is this into 2 divided by 5, revised number of shares, this plus this. So basically, the revised EPS is gonna be this. So your revised EPS is this. Now what actually happens was that what was the requirement? Revised EPS and the revised share price. Now for share price, PE ratio multiply by EPS is equivalent to share price. So share price is going to be this this EPS multiplied by P ratio is 8.88. 8.88. 8.88. Okay, okay, Ruben, that's okay. Now what next is there? So then it says calculate the current gearing and the revised gearing after the investment. Calculate the current gearing and the revised gearing after the investment in the project using market values and assuming the right issue is successful. So number 4 is basically what? Number 4 is current gearing. For the current gearing, your gearing ratio is being measured like this: non-current liabilities divided by non-current liabilities plus equity. Non-current liability, equity. Non-current liability is 25,000. Equity is gonna be what? Equity is gonna be the revised number of shares, which is 10,500 multiplied by 2 plus 27,875, which is the existing retained earning, plus the difference between the revised PAT and the existing PAT. So hence resultingly 51,899. So basically, sorry, it has to be done over there. So you see what happens is that the total gearing will be as follows: non-current liability divided by the sum of this plus this. So basically This is the existing, this is the current gearing. The revised gearing is gonna be like this. The non-current liability is gonna remain the same, but for the equity, the existing plus the equity is gonna be this number of shares multiplied by 2 plus 27,875 plus 9324 minus 6300. Now 51,899, and if I copy this, if I paste it, so it's 32.51. So a revised gearing is going to be 32.51. I'll just explain the current equity. See, what happens is that the equity is ordinary shares capital is 15,000 and this retained earning is 27,875. Can you sum up both of them and see that it comes out to be the same? Okay, now lastly, it says that discuss the views of the directors. Okay, now we use this. Now, if I mean, this is basically based on book value. This is based on book value. If I calculate based on market value, let's try to see what is the calculation going to be on the basis of market value. If I calculate on the basis of market value, non-current liability, and then equity. Non-current liability is gonna be the same, 25,000, 25,000. The equity is gonna be the existing number of shares were 7,500 multiplied by the existing market value was 8.4. So it gives you 63,000. Now, similarly, if I talk about the revised number of shares, this is this multiplied by 8.88 is 93,420. So resultingly, the gearing is gonna be what? The gearing is gonna be this. See, this is 28.4741. This is 21.41. Is that okay now? So basically now, how did I calculate the market value? I calculated the market value on the basis of the number of shares multiplied by the market value of share. Now, last requirement of the question is discuss the views of board directors and both the small and large investors, shareholders, in relation to the new project and its financing. So you have to talk about the directors and the both large and small shareholders. 5.5 marks means 5 pointers is what you have to mention. 5 marks means 5 pointers is what you have to mention. Yeah, can you think of 5 pointers on this? Can you think of 5 pointers on this? I'm giving you 5 minutes. Think of 5 pointers. Can you suggest? What 5 pointers can you suggest? Okay, now next part is that one of the Gram's non-executive director has suggested using Islamic finance, either a Mudarba contract or a Musharka contract as an alternative. Discuss the use of a Mudarba or a Musharka as possible alternative sources of finance. Now, can you think of some pointers? Okay, so now see what happens is that when we talk about the mudarba and when we talk about musharaka, mudarba is basically a person buys goods and sells them to another person on credit. The price charged is higher. The price charge is higher, and the price is known to and the price is known to so person buys goods the person buys goods and sells them to another person on credit. The price charge is higher. The person buys goods and sells them to another person on credit. The price charge is higher, and the price charge is higher, and the buyer knows the price at which seller purchased those goods. The date of return of the amount is agreed, and as per the Sharia principles, the seller is not entitled to charge any extra amount. The seller is not entitled to charge any extra amount. The seller is not entitled to charge any extra amount. This is an easy way of obtaining finance, as anything could be subject to a mudarba agreement and allows the financier to earn Sharia compliant return. When we talk about the musharaka, so what exactly do you mean by musharaka? Musharaka is basically musharaka refers to the partnership agreement between two or more people. The terms of the musharaka agreement are documented and each of the partner contributes and each of the partner contributes to the partnership. The business that the partnership can conduct would only include the allowed businesses as per the Islamic principles. Okay, let's move on to the next question now. Which is again an NPV question where you have got what? You have got this NPV question where the expected net present value is to be calculated. Now I'll just zoom out of the question in front of you. Can you just take a screenshot? Can you take a screenshot of this, please? Yeah, can you take a screenshot of this? Okay, can you take a screenshot of this also? And now give it a try. You need to calculate the NPV. You need to calculate the NPV. Genie Company is a listed company that manufactures innovative products for the telecommunication industry. Genie has just developed a new product called the LP500, which is expected to have a project life of 4 years. Genie Company's management has decided that sales price for the LP500 will be $90 per unit, as anything higher than this will dramatically reduce the expected annual life. This is 0, 1, 2, 3, and 4. Selling price. Okay. Selling price. Sales volume. 20,000. 20,000. 20,000. Then what else is there? It says that the variable cost of the LP includes the cost of a bought-in component X22. The price of X22 has been volatile due to supply problems with the manufacturers and consequently variable cost per unit. Variable cost per unit is uncertain. Variable cost per unit is uncertain. The management of Genie has made the following estimates of the variable cost per unit. So you need to calculate the expected variable cost per unit. Expected variable cost per unit is going to be what? Is going to be it's like 40 price probability. Forty, 50, 60, 70. It is 20%, 40%, 20%, 20%. Expected value is going to be this into this. Hence, this is what you have, 54. Now what else is there? Incremental fixed cost, contribution per unit, sales volume, total contribution, fixed cost. Fixed cost is 300,000 per year. All of the above figures are expressed in current price terms. Sale price inflation is expected to be 5% year per year. Variable cost is expected to be so, and this is so and so. So that means the selling price, which is gonna be 90 into 1.05. The variable cost is expected to increase by 3%. The contribution is going to be this plus this. Total contribution is going to be this into this. Now the fixed cost is 300,000 per year and it is expected to increase by 3%. 300,000 into 1.03. Okay, then this is actually going to be this into 1.03. So basically the I'm actually just going to put this here. Now new equipment costing 1.5 million needs to be purchased at the start of the first year of operation and expected to have a residual value of so. They pay corporation tax at 20% and taxes payable at the end of the year. Okay. Then here what you could do is that you could talk about depreciation. You could talk about depreciation. So the depreciation is going to be, it's like 1.5 million expected to have a residual value at the end of the 4 year. Tax allowable depreciation at 25% on a reducing balance basis. So it is actually going to be 1.5 into 10 raised to power 6 into 25%. Now for the last year, it is actually gonna be cost, total depreciation, residual value, residual value, total depreciation is gonna be sum of this. The residual value is gonna be the balance is gonna be this plus this plus this 507812. So profit before tax is gonna be this. The tax at the rate of 20% is gonna be this into 20%. And then the profit after tax, sorry, then what happens is that you have to add back the depreciation, investment, cash flows. No, working capital, and then the cash flows. Okay, so the same depreciation that was deducted needs to be added back. Okay, so this depreciation needs to be added back. I'm adding it back. The investment is 1.5 into 10 raised to power 6. And then the 125,000 is what the redemption is. The residual value working capital is so and so. It is expected to be 3% per year. Now for the working capital, we need to do the separate calculation. Working capital, year, working capital, incremental, 1, 2, 3, 4. This is gonna grow by 3%. The incremental is this minus this minus this. Now, so what actually happens is that this is this 100,000 initially, then this, then you have got this, then you have got this, and then you have got this. So the cash flows are gonna be what? Okay, now what I can actually do here is that I could just do the rounding off. Okay, now what actually happens is that so can you just see the NPV on this? Can you just see the NPV on this? Okay, discuss how your decision in A will help achieve their primary objective. They manufacture innovative products for the telecom industry. They've developed a new product, so and so, so and so. Um, discuss 3 limitations of using probability analysis and deciding whether or not to proceed with the LP 500. So the estimations could go wrong. The expected value averages out both the positive and the negative outcomes. The actual results may be very different to the results predicted using probability analysis. So basically, this is how you are actually going to answer the question. Now, so what we have done is that we have actually gone through both the June 2023 and the December 2023 examination. And I hope that you would have actually enjoyed this session, and this would have actually helped you gain more confidence as to how the questions have to be attempted. Now, so thank you very much for joining in. Thank you for your time. Thank you for being here. We would be sharing the recordings of the session of today with you people so that you can actually get access to it and you can view it, you can watch them, right? So thank you for your time. Thank you for being here. See you again, inshallah. And best of luck for the results.